Citadel currently has assets under management of just over 20 billion rand. The group's strategist, Maarten Ackerman, joins us in studio for some investment insights. Maarten, thanks very much for your time. Let's start with your thoughts on the global environment right now and how that translates into what we should be doing in South Africa. Hopefully, it's not running for the hills.
Yeah, I think, unfortunately, if we look at the global landscape at the moment, it is very much influenced by the political side. If you just think about Europe, the fact that we've been seeing this crisis now for longer than 3 years is a good indication that the political powers are really preventing us to get to a solution. If we only rely on the economic side of it, the market will correct much easier or much quicker. As a result of that, it creates uncertainty, and that uncertainty will stay with us for probably another 2-3 years until we see that there's a potential solution on the table. So in this kind of environment, that's why we see markets so unsure, jumping up and down, not finding any direction. So for us as longer term investors, it's important for us to say, well, let's understand what we buy, what we get, and what we pay for that. And then try to get away from all the negativity and the emotions that's causing.
So ignore the noise, the old proverbial ignore the noise.
Right.
And this is in line with your thinking, isn't it, Chris?
No, very much so. And just to add on to what Maarten was saying, I mean, it's not just in Europe. You're looking at the US, absolutely transfixed now with the presidential election coming up in early November. And in China, their attention seems to be on this once in every 10-year election there as well. So it's a great pity. But one of the things that we've been looking at very closely for a while now is interest rates. And from a longer term, not a mechanical perspective, from a longer term demographic perspective, and they seem to be going lower and lower and lower and lower. I don't know, how do you feel about that?
Yeah, I think, once again, I think this is definitely an action from the government side. What they're trying to do in the developed world is to actually get interest rates below inflation and keep it there. So that is exactly where we are today. If you think about the US, the UK, even Europe, long-term interest rates running around 1.5%, but inflation is still 2.5%. So what they're trying to achieve is to, by doing that, is to deflate the debt levels. So they're taking savings from future generations to pay back their debt. So that's part of the deleveraging, and that's something that will take a long time. And that's why we believe that, yes, at 1.5, bonds is not a great buy. There's a major risk of a capital loss going forward. But I don't think interest rates will normalize in the next maybe 18 months or so, because the governments will try and keep it there so that they can deflate the debt levels. And tomorrow again we'll get some indication from the ECB whether they're going to buy bonds. So I think the signs and the indications are that the government will keep intervening, trying to keep yields at these kind of levels to deflate debt.
Where are our interest rates going from here?
Well, if you think about the local interest rates, we've also seen a massive decline. We're around about 7 in terms of the long-term rates. I think there's more downward pressure, which is good. I think we're more bullish on South African bonds versus global bonds. We think there's a little bit more room to go on the local side. The reasons behind that is global investors are still looking for higher yields, so they're moving into these markets. And maybe a technical thing, the fact that next month we join the global bond index. Now we're a very small part of that bond index, but that means that if people just track the global bond index, that's around about a 60 billion potential inflow that can move into this market, and that can further push yields down. So we're more bullish on local bonds versus global bonds. So in the local market, yes, it might still be opportunity in global bond yields, but the direction is also down.
Is that in line with your thinking on interest rates?
Very much so. I put out a wee paper a couple of weeks ago, and looking more at the demographics. In other words, you've got a lot of baby boomers who are at or near retirement, and these are people who actually don't spend money on credit. They've got lots of their own money, and they're not seduced by ephemera. So they buy big things with cash. Unfortunately, the other end of the spectrum, you've got a lot of younger people who do like buying on credit, but they're largely unemployed. So you've got banks and the authorities caught in this nasty vice. And what do? Keep on pushing rates lower and lower and lower, trying to get people to bite, but they're not biting. But I think they're going to keep on pushing them lower for quite some time to come.
If you look at other asset classes in South Africa, what are your thoughts? Where should we be putting our money?
Well, if we start with the interest rates, as an investor, you've got a few options. You can put your money in cash, you can lend it to the government, or you can buy some equity. Globally, including South Africa, we say, well, keep cash only if you really need it to fund some expenditure. When you get to lending to governments, globally we're very cautious. If you need to make an investment there, stay short duration. Think about alternatives like corporate bonds or even high yield bonds. I've explained that in South Africa we're still fairly bullish on government bonds, so that's
So
fine.
you can continue to lend to the South African government, in other words?
At these kind of levels, yes, we think that there's still some upside as yields get pushed down further given these fundamentals we spoke about. And then you get to equity markets. Now we know as equity investors you need to take a longer term view. But if you just look at what you buy today, what you pay for it, and the kind of dividend yields that you get, we do think that it is prudent for investors to have a fair share amount in equities, probably more global equities than emerging markets and South Africa. But if we turn to South Africa had a very interesting year to date. We've seen a massive divergence between financials, industrials on the one hand, and the resources on the other hand. And resources basically is on the back of this fear about China seeing a hard landing, the ripple effect onto commodity countries, currencies, Canada, Australia, South Africa. If we look at the fundamentals, we believe that it's probably a little bit of an overreaction. A lot of it's already priced into the market. So if you stand back then you say, well, you know, China's not going to fall down the earth, you know, they're slowing. It's part
but
of
it's not
things.
it's not a crisis.
It's not a crisis. It's basically two things. You know, they're a massive economy that started to industrialize 10, 15 years ago. If we didn't have this crisis, you will also expect after 10 to 15 years that an economy like that should start to slow in terms of the growth that they generate. On top of that, they're also facing the global crisis with less exports to Europe. So if you look at that, the 7 kind of growth that they generate is still fairly okay. And with that kind of growth, there will still be demand for commodities.
So we should be taking opportunity now to buy into resources as where you're going.
So what we are basically saying is if you can buy some of the resources companies at a single digit PE versus some of our retail companies, which is north of 25, you know, double digit kind of PEs, then we would say start to overweight some of them.
The bottom line though is that resources keep getting cheaper and your retail stocks keep going higher.
Well, that is, you know, as value investors.
Does it have to change?
Well, put it this way, we always know that what you pay in the end is really going to determine your performance or your return on your portfolio. As value investors, we know that sometimes it takes longer to unlock that value. All we can say is right now, if you can buy a company like BHP Billiton at a single PE and they pay a 4% dividend yield, that's a good investment to make for the longer term. Yes, you might see volatility in your portfolio, but that's why it's part of your longer term portfolio or longer term investment. So you get a decent dividend yield, you buy them at a discount, and at some point that value will unlock. If you go the other side where you buy some of those retail companies, you definitely overpay, and we know that over time, whether it's 5 or 10 years, it will be tough to double your returns in such an investment.
Are you accumulating the likes of BHP, Anglo American, Sasol at current levels?
Sasol is one that sticks out. I mean, Sasol is an absolute beaut as far as we're concerned. I mean, we have all 3 of those in the portfolio. The resources you've mentioned, the BHPs and Anglos, I agree with Maarten entirely. I mean, I think the longer term commodity super cycle is still very much intact. And from that aspect, we would still be holding on to those. But it is concerning that, as you rightly point out, they're getting cheaper and cheaper and cheaper. And maybe, you know, if you look at
Don't try and catch a falling knife, isn't that,
well,
isn't that what they say?
Precisely. If you look at our industrial side, our financials and industrials, there's a lot better growth involved there. And it's interesting, you're getting some nice dividend growth coming out of many of these companies as well. So I think, what I'm saying is I think it's much more of a stock picker's market at this point in time. You can't just blindly go and buy the market and think
and say a sector play, you're going into
so.
resources.
Yes.
You've got to say, this is my play within the resources.
Yeah, I think you should be clever in terms of where you pick stocks and how you pick them. I think just like we said, the big divergence currently is between the resources and the industrials. If you just think, let's turn to the retail stocks. You know, if you think about most of the fruit retailers in South Africa, they're north of 20 in terms of a PE ratio. And if you compare that to Tesco's in the UK, they've got a PE ratio below 5, they pay a dividend of 4, they're expanding into China. So that's why we say stock picking is important. So rather than use some of your capital to buy a retail company like that expands also into emerging markets, instead of buying a very expensive food retailer in South Africa, which already had a massive run.
It's called the foreign effect into our retailers. I suppose that's the biggest risk as well. If we go into a situation which will exacerbate some negativity in the global economy, that risk off trade comes back into play, would foreigners pull out of our retail stocks in line with a big risk off play, and perhaps then you've got a calamity on your hands if you invested in those stocks?
Yes, I think so. I think you're right. There is a lot of foreign demand. We know that over the past few years, with all the issues in the developed markets, we've benefited from that. It helped us massively in terms of financing our current account deficit, foreigners moving into the economy or into our stocks and our bonds. But we know it's hot money, so it's for them. It's not a long-term investment. They're not really trying to invest in the country as such. They want to get exposure to emerging markets. Doing it through South Africa is very liquid, very easy to do that on the JSE. We know that in dollar terms we correlate very much with the rest of the BRIC countries. And if there's any sentiment change tomorrow, it's a click of a button and they will be out. And you will see a reversal of those valuation and prices, definitely.